Hello, everybody, and welcome into this week's episode of the Magnify Wealth Podcast. I'm here with your host, Scott Gannon. So now it's time, guys, for the part two of our two-parter on retirement risks and how you can greatly mitigate these risks. So we're going to start here today by doing a little bit of an introduction for those of you that are new to our podcast on what infinite banking is, because infinite banking is the key to mitigating these risks. Scott, you want to fill in the viewers?
Yeah, sure. So for those people, this is your first podcast watching. For the benefit, I'll just give you a short description. We are in the infinite banking lane, if you will, of financial strategies. And infinite banking basically is centered around acquiring a specifically designed, high cash value, dividend paying life insurance policy, permanent whole life insurance. And that asset is something you can use all through your life without affecting the growth of the cash value or the death benefit. The death benefit keeps growing as well. And that is what we're going to talk a lot about today. We're going to talk about death benefit, how that comes into effect, as well as we're going to have a short little spell about how the cash value can be used to your benefit, even in retirement as well. And yeah, that's I guess the Coles Notes version of this. And of course, really look for more once. Sorry, go ahead.
The key with infinite banking is you utilize this policy to finance your lifestyle, but you don't just stop there. You can actually finance your retirement using it when done correctly.
Okay, so want to get started?
Yeah, let's do it. So the first area that infinite banking helps with in retirement is it becomes a buffer asset. What's a buffer asset?
So before I explain that, I'm just going to kind of slightly clarify. It doesn't have to be an infinite banking policy. What we're talking about as a buffer asset is anything that produces, like, there's I guess what I'm trying to do is clarify. There isn't any such thing as a specific infinite banking insurance policy. There's policies that work really well for infinite banking. But what we're talking about is utilizing the cash value in retirement with the buffer asset. What is a buffer asset? Because the cash value in a life insurance policy designed this way is guaranteed to never go backwards. What that means is it never goes down in value. In fact, every single day it gets more. It gets higher, even when you're utilizing it, because we use it in a very strategic way with loans. So it always grows. So you can use this in times when other assets, this is why we call it a buffer assets, are not doing the greatest. They're either losing or simply underperforming, whether that be in the stock market, which is obviously a really common one. People put money, people sell off their businesses, sell off their assets or whatever, and then they put that money in the stock market. It's a common strategy in retirement. And now they're at the risk of stock market volatility, which we talked about as one of the risks in the prior episode. So what this does is once you experience the losses, and we just kind of demonstrate this on a yearly basis, but if you have a loss, then you stop taking income from your investments and you utilize the cash value in the life insurance policy as your buffer asset. Why? Because it's completely uncorrelated, which means that it doesn't act like the market. And what that means is it's going to be higher than the year before, it's going to be higher the next year. So you can utilize that as a tax-free source of income during that time when you're allowing the other investments to recover or just perform better. And I talk specifically about stock markets, but this could be the volatility of an asset of a rental property, just having vacancies, or a business that you're doing an earn-out on. So what that means is for I'm sure most business owners probably do know, it's when somebody's buying you out, but they're going to give you an income over time in retirement to buy out your business. Well, if the business doesn't perform so well, then they may not have the money in a given year or enough money to pay whatever that earn-out is. So if that hiccup actually happens, like businesses shutting down during the pandemics, as an example, you still have that buffer asset in there as a source of cash flow, so you can still live abundantly in your retirement.
Awesome. So now we're going to go to something kind of similar, I guess, would be the best way to say it, and that's there's a generally accepted number you hear in the finance world of what you can draw upon of your assets year after year to fund your retirement.
Yeah. So we're going to talk a little bit about rate of return here and what gets assumed or planned for when you're planning your income with your advisor. So what happens is because you're relying on this money for your income, the inherent belief is that you should not take any more risk, which is probably a good relief. Now there's ways to deal with that and mitigate it through what's called cash flow wedges and things like that. But generally speaking, there was a study done in the 90s called the Trinity study. And the Trinity study came back, and don't forget that this was, I shouldn't say don't forget, just so you know, this was probably after the biggest 25-year bull run in the markets in history. And it came back that a safe spending rate, and what that means is having at least $1 left at the end of your retirement years, and having a good, having $1 left at the end of your retirement. So it could be, you could measure it for 25, 30, or 35 years, whatever your measurement is. So there's a graph that shows what your best chance is of having at least $1 left at the end of those years. So that was back in the 90s. Today,
and it was 4% in the 90s.
It was 4% in the 90s, and today that number is about 3 to 3.5%. So the key to having that buffer asset, so that you can the key to dealing with this is it goes right back to the buffer asset, in that the buffer asset allows you to be able to invest for higher returns as opposed to just staying on the sidelines, so to speak, to make sure you got your 3 or 3.5. You can actually plan or hope for in the stock market, but you can also plan for in certain ways, and there are income sources that you can generate that will produce better than having your money at risk.
The real summary of that is, you need safety in retirement. So, one strategy is being super safe in the market and not getting much return, and being in a tough spot where you might have to, live a lower standard of life than you'd like to. Or the other way is have your buffer asset as your safety, and then you can actually invest for higher returns because you are safe.
Yeah, it just generally allows you to, as much as I hate to say this word out loud because I hate the word risk, because we like to plan for inevitables and allow people to have investments they understand to reduce risk. The fact is risk is less of an issue with a buffer asset, period. That's, full stop.
Exactly. So one of the big points we touched on last week was tax.
Yes.
It was, we have no idea what tax rates will be in the future. We could probably assume they're going to be higher, but you never know. That the government debts are egregiously high right now, so they're going to need money. Healthcare costs are scary. So again, they're going to need money. So Scott, why don't you fill in the viewers on how using infinite banking as a retirement strategy can actually help you get around these scary future taxes that are coming our way, or could be coming our way.
Yeah. So essentially, when you develop you set up your own bank or infinite banking, and you build out these, like we always say, you literally are becoming a bank. You need to act like a bank, you're thinking like a bank, and this bank is going to keep growing, okay? And that growth is in usable cash in retirement as well as death benefit. And that is so key, because that usable cash, structured properly, can produce a tax-free income throughout your whole retirement if you want. And we like I said, we talk about it as a buffer asset when you're using other assets. But you could literally go into retirement with this as your only asset. Not that we ever suggest that that's the way you should do things, but you can actually literally go in and know that every cent you draw in the way of an income from this will be tax-free as long as you structure it properly. Again, we're not giving tax advice on this. There could be tax implications. So make sure that you're talking to somebody that really knows what they're doing in order to set this up if you're looking to set it up. And of course, we're always a phone call away for that. We know how to do it.
All right. I think you might have gave a sneak peek at one more thing there, and there's a death benefit involved in doing it this way, which is can get really, really important when you want to leave a legacy for either kids, charity, whoever, and
the government if you don't plan it properly.
But you're building up all these assets and then you spend them down in retirement. Well, this is a great way to ensure you can still pass on the legacy.
Yeah, death benefit has there's a lot going on with the death benefit that a lot of people just don't think about. And what I mean by that is if you think of why people buy life insurance, just go back to when you were 30 years old. If you're still under 30, then just think about it now. Like, what people tend to buy life insurance for is to protect their income for their family. So if they have a young family or a spouse, or even if they want to just pay off debts, it's the fact that they don't want to leave somebody else in a lurch if they pass away prematurely. So they use life insurance as that risk eliminator. So this is no different in retirement. So when you're in retirement, you are, I'm going to backtrack a little bit here. So a lot of people out there think that you don't need life insurance in retirement because you don't have an income to insure, but you don't have an active income to insure. But now you have a passive income. And that is also can benefit from being insured. I'm not saying it necessarily has to be. I mean, your own income when you're working doesn't have to be, but people do it because it's a responsible thing to do. So if you look at this from a perspective of you're protecting your assets instead of your job or your ability to earn, that's really what it is. We're protecting an income. So if you say focused on the income side of this, so passive income, what are you doing? If you pass away or when you pass away, your spouse and or heirs, they get that asset gets replenished. That asset that was producing the income. Before you retire, when you're still working, you're the asset. Now the assets are financial assets or physical assets or whatever, but they still need to be replenished, even though you pass away. So it is truly asset insurance, if you want to think. There's no such thing. It's actually life insurance.
Awesome.
So to kind of look at how all this kind of ties together is there's if you actually, I'm going to backtrack a little bit. So you're insuring that income for your spouse. Once your spouse is gone, or whoever you're responsible for, it might be a dependent child or whatever. So once those people are gone, now it's about legacy. So do you want a legacy? Everybody I talk to when they're younger, it's not a priority. 100% of people I talk to that are retired want to leave something. And preserving assets, which is the most common approach for people because they're either haven't insured or they're not insurable or whatever, is the least efficient and most expensive way to do it. If you have life insurance, that is the absolute best way to provide a legacy. You go from scarcity you go from a scarcity of trying not to spend to preserve your assets to being able to just spend them all and know that number one is your assets are the most likely part that the government's going to go after. So if you can spend those down and spend those gone, then you're leaving less for the government. And why? Because life insurance benefits are tax-free. You leave life insurance, death benefits, and guess who gets that? Your heirs, your legacy, what you plan. That's really what it is.
So to really tie this all together, what's important to realize is if you properly set up, and follow infinite banking as your strategy, as you're focused on retirement, you can actually expect to have 70 to 100% higher cash flow in your retirement years. And on top of that, leave a guaranteed legacy for your heirs.
Yeah, so the 70 to 100% higher is in relation to basically not being insured.
Awesome. Well, there you have it, folks. Tune in next week for another episode of the Magnify Wealth podcast. Signing off, we're your hosts, Cameron and Scott Gannon.
Have a great week.
Thanks for tuning in to the Magnify Wealth podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.